HELOCs will disappear, and here's why. Welcome back to the Industry Leader Update. It was just 2 short years ago that several major banks stopped offering HELOCs or home equity lines of credit. Wells Fargo and JP Chase were the most notable lenders who cited an uncertain economy in the early days of the COVID-19 pandemic and the shutdowns as a rationale for hitting the pause button on home equity loans. While the pandemic may be behind us, we may be seeing HELOC lending suspended again. Today, banks remain wary of the risk of home equity loans, especially those that are in a second lien position, and that exposes the lender to the increased risk of loss should their borrower suffer a financial setback that makes payments impractical or impossible. Now, the previous curtailment of HECM lending has been a minor inconvenience, with most opting instead in recent years for a cash-out refinance. However, with mortgage rates 2 percentage points higher than they were just a year ago, cash-out refis are no longer practical. Even homeowners who have already secured a HELOC, they are at risk of losing access to their home's equity. On its website, Chase explains the basics of a HELOC suspension, saying, "You will not be able to draw additional funds from your home equity line of credit if it's suspended. Suspended accounts must be reviewed for reinstatement of your credit line." While many suspensions are based on an individual borrower's change in financial circumstances or hardship, the blanket freezing of home equity lines of credit or credit lines can be enacted by a bank as they see fit. Now, HELOCs have disappeared. History has taught us that it can and will happen in certain times, and those who may have already secured a HELOC are likely to see their credit line suspended at some point in the future. In fact, during the 2008 housing crash, banks froze existing HELOCs and personal lines of credit, and they ceased offering HELOC loans altogether. And it's not rocket science. Banks' equity positions were no longer secure at that time. In fact, in many cases, it was completely gone as home values tanked. Now, while a nationwide crash in home values is unlikely, we are seeing the early warning signs of home value declines in several metropolitan areas. Sellers are beginning to show signs of desperation, and they're slashing their prices. And that trend is likely to spread to other metros, and that increases the pace of reductions in home asking prices, and subsequently it does soften the housing market in specific regions. Now, here are median listing prices cuts or median listing price reductions for 15 metropolitan areas, with San Jose leading the pack with the highest median drop in home asking prices. That should not be surprising for San Jose, since the median home value is $1.3 million. Then next we have Honolulu, Hawaii, San Francisco, Los Angeles, and San Diego, California. More home sellers are reducing their prices, the most especially in New York, with the largest increase in home price reductions by $28,000. Now, you can check out your own market or those that we've shown here in the video, and you're going to see price reductions in many times in the attempt to attract a buyer who is struggling with higher mortgage interest rates or perhaps a lack of affordability. But there is good news. Older homeowners who have substantial home equity could qualify for a line of credit in the federally insured reverse mortgage, what we like to call the HECM, or the home equity conversion mortgage. Unlike a traditional HELOC, the line of credit in a HECM cannot be reduced when home values drop or even if they fall precipitously. Even better, the unused portion of the line of credit in the HECM grows each and every month, and that increases the homeowner's future borrowing power. Also, unlike the federally insured reverse mortgage, HELOC borrowers are actually facing the risk of payment shock. During the initial HELOC draw period, interest-only payments are required. But after that draw period expires, then it's recast into monthly principal and interest payments for a term that's set by the lender. That's typically 10 to 20 years. Now, certainly the overall loan cost of a reverse mortgage we know are substantially higher than a HELOC, but homeowners that are seeking the flexibility of making reduced payments each month or no monthly payments at all, and also having a secure growing line of credit, they may be willing to pay the price of entry. Older homeowners who choose to get a HELOC today, could be in for an unpleasant surprise tomorrow if market conditions lead to their credit line being frozen. Consequently, the HECM deserves serious consideration for those that are looking for the ability to tap into their home's equity today, tomorrow, and in the years to come. And remember, you cannot advertise that HELOCs are going to disappear at some point in the future, but you should certainly have that discussion with borrowers that are considering either a HELOC or a HECM, and then let them know the differences between the two. That's it for us today. Be sure to leave your comments in the comment section below. And please share this video with others on your social media platforms, Facebook, LinkedIn, and Twitter. And each and every week, we have our latest videos on our YouTube channel, HECM World. You can subscribe and also hit the notification bell. That way you never miss an upcoming episode. And each and every week as well, we have our podcast, HECM World Weekly, where we bring you the most important reverse mortgage news and commentary. You can listen to it no matter where you are. Thanks again for joining us, and be sure to return next week for more reverse mortgage news, commentary, and analysis here at HECM World.